Most manual day traders are almost guaranteed to fail, not because they are stupid, not because making money in markets is completely impossible. They fail because they enter one of the most competitive games in the world with no proven advantage, limited capital, emotional decision making, and a strategy they learned from some random guy on YouTube. And somehow, they think that will be enough. The biggest problem with manual day trading is that most traders never prove they have a real edge. They learn a strategy, watch a few examples where it worked, and immediately assume it will keep working. Maybe it's an opening range breakout. Maybe it's RSI. Maybe it's support and resistance, order blocks, liquidity sweeps, or some custom indicator being sold for $99 a month. But seeing a few successful trades is not proof. A chart pattern is not automatically an edge. A real edge must survive hundreds or thousands of trades, different stocks, changing market conditions, transaction costs, slippage, and losing streaks. Most retail traders never test any of that. They are not trading evidence. They are trading hope. Now look at professional quantitative trading firms. They employ mathematicians, programmers, statisticians, researchers, and market specialists. They have massive historical databases, expensive infrastructure, advanced execution systems, and strict risk controls. They can test thousands of strategies across thousands of stocks, futures, currencies, and market conditions going back many years. And despite all of that, most strategies they test still fail. Some only worked because of luck. Some collapse when tested on new data. Some disappear after fees and slippage. Others stop working when market conditions change. So think about how absurd the retail trader's confidence can be. Professional researchers with enormous resources struggle to find durable market inefficiencies. But someone watches 6 hours of YouTube, learns 3 chart patterns, opens a brokerage account, and thinks they're ready to generate a full-time income. That is not confidence. That is ignorance of the competition. The average retail trader's so-called backtest is usually meaningless. They scroll backward through charts already knowing what happened next. They notice the clean setups and ignore the ugly ones. They change the rules whenever a trade would have lost. They forget spreads, commissions, slippage, and missed entries. Then they calculate a fantasy return and call the strategy profitable. That is not research. It is storytelling with charts. The more strategies and settings you test, the easier it is to find something that looked amazing in the past purely by chance. Professional quants call this overfitting. Retail traders often call it their system. Every time a retail trader enters a position, someone is on the other side. That other participant might be a market maker. It might be a hedge fund. It might be an institutional algorithm analyzing price, volume, volatility, order flow, and related markets in milliseconds. These firms often have better data, faster execution, lower costs, more capital, and more experience. The retail trader is not playing against a room full of beginners. They are competing in one of the fastest, most efficient, and most heavily researched markets on earth. And their weapon is usually a delayed chart and a pattern they learned last month. Even when a trader has a reasonable strategy, human psychology can destroy it. Algorithms do not panic. They do not revenge trade after a loss. They do not double their position because they want to make the money back. They do not hesitate, get bored, chase a move, or abandon the rules after 3 losing trades. Humans do all of those things. A trader can spend months developing a strategy and destroy it in one emotional afternoon. And the more someone depends on trading income, the worse that pressure becomes. Every loss feels personal. Every missed trade feels like lost income. Every winning streak creates overconfidence. Eventually, the trader is no longer following a system. They are reacting to fear and frustration. Then there is the trading pure industry. Many influencers selling courses, indicators, communities, and signals may have a more reliable business model than the strategy they are teaching. Courses produce predictable revenue. Subscriptions produce predictable revenue. Affiliate links and broker referrals produce predictable revenue. Day trading does not. That does not mean every educator is a fraud. But a rented car, a profit screenshot, and a few winning trades are not proof of long-term profitability. Sometimes the easiest way to make money from day trading is to sell day trading to other people. This does not mean that absolutely nobody can succeed. A small number of traders may develop genuine skill, strong risk management, disciplined execution, and a measurable edge, but they are the exception. The average manual day trader has no statistically validated advantage, no serious research process, limited capital, emotional decision-making, and professional competition with vastly superior resources. The harsh reality is that most manual day traders are not running a business. They are running an expensive experiment with their money, time, and mental health. If world-class quantitative firms can test thousands of strategies and still struggle to find durable market edges, it is irrational to assume that a random strategy from a YouTube guru will magically produce consistent profits. Most traders will not beat the market. They will spend years trying to prove that they can. And by the time they accept that they never had an edge, the market may have already taken their money, confidence, and sanity. Without evidence, trading is gambling with extra steps.